Hey everyone, welcome back to Noobs Selling Options. I'm absolutely pumped to have you here today. We're diving into a special market explainer based on two incredible new research sources that really dig into the macroeconomic realities behind the whole AI boom. You know, as traders, it's just so incredibly easy to get swept up in the daily price action of semiconductor stocks, right? But to truly position ourselves for the next 12 to 24 months, we need to understand what this research says about the fundamental architecture driving this market. And, maybe more importantly, what happens if that structural thesis breaks. So, here's our roadmap for today's explainer. 1. The trillion-dollar question. 2. The zombie GPU vortex. 3. The valuation guillotine. 4. The credit freeze. 5. The macro silver lining. And 6. Real market crash probabilities. Let's just jump right in.
Section 1. The trillion-dollar question. What if AI is a hoax? Now hold on a second. I want to be perfectly clear right out of the gate. When the research uses the word hoax here, we're not talking about some malicious sci-fi conspiracy theory. Obviously, the tech exists. What we mean by hoax in a strict financial context is a systemic macroeconomic misallocation of capital. Basically, we're asking, what happens if generative AI just can't scale past its current limitations? You know, things like high latency, astronomical energy costs, persistent hallucinations, and a lack of true reasoning. What if it just can't achieve actual enterprise-level profitability?
And to understand why that misallocation would be so devastating, get a load of this number. $660 to $690 billion. Let that sink in for a second. That is the estimated AI infrastructure capital expenditure, the CAPEX, committed by top hyperscalers for the year 2026 alone. Companies like Microsoft, Alphabet, Amazon, Meta, and Oracle are pouring nearly $1 trillion into data centers and chips. The entire market rally rests on the premise that this massive spend is an investment in future growth. But if that enterprise revenue doesn't actually show up, well, this CAPEX instantly transforms into massive, value-destructive overcapacity.
Which brings us to Section 2, the zombie GPU vortex.
Let's look at how this builds into what the research calls the microeconomic fallout. What actually happens to all that physical infrastructure if the music stops? Well, think about the difference between previous tech bubbles and today. Back during the SaaS overinvestment periods, failed companies just left behind bad code that vanished into thin air. Poof, gone. But we are in hardware cycle right now. Hardware overinvestment leaves behind highly specialized physical assets. If AI turns out to be a commercial dead end, we enter the terrifying zombie GPU vortex. We're talking about thousands upon thousands of high-end GPUs sitting completely idle in giant warehouses, and they'd have practically zero secondary market value because they're overly specialized and largely useless for traditional computing workloads.
All right, Section 3, the valuation guillotine.
So, we've got warehouses full of zombie GPUs. What does that actually mean for the stock market? Listen up, because for the options traders in the noob selling options community, this is the crucial math you absolutely must respect. Right now, the S&P 500 is trading at a highly elevated forward PE of around 22.8. Analysts are justifying this massive premium by forecasting incredible margins, expecting earnings per share to jump 24% year over year in 2026. But if that AI growth engine gets ripped out, that premium evaporates overnight. The forward PE would violently mean revert down to its historical average of 16. Simultaneously, that 24% EPS growth expectation, it collapses back down to a baseline secular growth rate of about 5%. When you combine a multiple contraction from 23 down to 16 with collapsing earnings expectations, the pure math dictates a 30 to 40% structural correction in the aggregate value of the S&P 500. That, my friends, is the valuation guillotine.
Section 4, the credit freeze. Because a 40% haircut in equities, that's really only half the story. The contagion wouldn't just stop there. The sources warn it would immediately bleed into corporate debt markets. Let's walk through this step by step. Step 1. To fund this gold rush, specialized neocloud providers have issued massive amounts of high-yield debt. If AI revenues fail, these providers face immediate stress and default, which triggers a deep freeze in the corporate bond market. Step 2. What about the megacaps? Well, aggregate capex is projected to absorb nearly 94% of their operating cash flow over the 2026 to 2027 cycle. If these investments yield zero cash returns, these historically cash-rich giants will have to divert whatever operational cash they have left just to service or pay down their mountain of infrastructure debt. And that leads us to the fatal Step 3, the death of share buybacks. The massive buyback programs that have historically put a structural floor under mega-cap stock prices would completely dry up. Without that floor, the free fall just accelerates.
Section 5, the macro silver lining.
Okay, take a deep breath. I know all of that sounds apocalyptic, but there's a fascinating pivot outlined in the data.
A structural recalibration of the broader economy would actually follow this hypothetical tech crash. Institutional capital is incredibly dynamic. If the growth premium for megacap tech vanishes, that money doesn't just disappear into the void. Capital rotates, and it rotates violently. It would flood out of tech and directly into the other 490, meaning the asset-heavy, cash-generative traditional value sectors. We're talking industrials, consumer staples, healthcare, financials, sectors that currently trade at very modest multiples. So the market survives, it just violently transitions back to an era where corporate value is determined by immediate free cash flows rather than exponential technological hype.
And there's actually a secondary silver lining here too. Think about the incredible strain AI data centers are currently putting on global energy grids and copper supplies. If the AI build-out suddenly stops, that tremendous pressure vanishes almost overnight. Power prices would plunge, and the localized inflation caused by data center construction would reverse. This sudden deflationary wave would give central banks immense room to cut interest rates aggressively, providing a really powerful cushion for the broader macroeconomy.
Which brings us to Section 6, Real Market Crash Probabilities.
Okay, we've explored the what-if doomsday scenario. Now it's time to look at the research and shift our focus to an objective, calculated reality check. To understand the actual probabilities, we first have to grasp the massive disconnect happening right now on the ground. We have a severe enterprise ROI bottleneck. Recent 2026 enterprise adoption surveys reveal a pretty stark reality. Nearly 97% of executives are currently deploying AI pilots or agents. I mean, everyone is trying it. But here is the kicker. Only 20% to 29% report seeing significant organizational return on investment. Businesses are finding out that integrating AI into legacy corporate workflows is way more expensive, complex, and prone to governance failures than Wall Street initially thought. This gap between infrastructure spending and actual enterprise ROI is the very real risk that's driving a potential bubble.
So let's carefully walk through the verdicts from the research and assign some probabilities over the next 12 to 24 months. First up, secular AI growth. This is the scenario where AI steadily monetizes and corporate margins expand to justify the current S&P 500 valuations. We assign this a 50% to 55% probability. In this case, the market just continues grinding higher. Second, we have the AI cyclical pop, or the capex bust. This means the tech is real, but companies overbuilt infrastructure way too fast, capex freezes, leading to a sharp, violent 20% to 30% tech sector correction, and capital rotates to non-tech. We assign a massive 35% to 45% probability to this outcome. Finally, the total hoax or dead end, where scaling completely fails, there's zero long-term utility, and we get a systemic 1999-style crash. Because foundational AI is already generating multi-billion-dollar recurring revenues and showing real-world labor reductions of 20% to 40% in specific tasks, the probability of this total doomsday scenario is actually quite low. It sits at just 5% to 10%.
Breaking down these probabilities, you should definitely feel a sense of relief knowing the total hoax is the absolute smallest slice of the pie. The foundational companies aren't going bankrupt anytime soon. They have legacy monopolies like Windows and Google Search that just print cash. But as traders, you cannot ignore that middle scenario. The cyclical pop is a massive 35% to 45% highly probable risk that you absolutely must respect. The market is increasingly punishing companies that spend heavily on AI without proving immediate monetization. And if that trend accelerates, that 45% slice becomes our reality very, very quickly. To synthesize everything we've covered today in this explainer, I want to leave you with this exact quote from the research. We are currently tracking a classic Gartner hype cycle. The technology is structurally real, but the stock market has priced in a flawless, hyper-accelerated adoption curve. The market has completely ignored physical bottlenecks like power grids and chip supply, and it has heavily underestimated the friction of enterprise integration. The tech isn't fake, but the financial expectations are dangerously decoupled from physical realities.
So I want to leave you with this provocative thought to ponder today. With a near 45% chance of a severe capex bust and a violent tech correction on the horizon, how exactly is your portfolio positioned right now? Are you blindly holding mega-cap tech, or are you prepared for the great rotation into the other 490? Let me know your strategies in the comments below. If you found this explainer valuable, please hit that like button, subscribe to the Noob Selling Options channel, and turn on notifications so you never miss our deep dives into the realities of the market. Keep learning, keep adapting, and I'll catch you in the next explainer.